Good evening, everyone. So we are now in our week 6 of our financial information class. So we are scheduled to complete the discussion on internal and external financing, as well as the discussion on cash flow statement. Hopefully, we can finish the cash flow statement. But we're just waiting for some of you guys to join us in this week 6 class. So we'll be waiting for about 2 minutes, and we'll probably start after 2 minutes. So uh, I'll wait for some of you to join the class, and then we'll start. Okay. Good evening, Janeline. Good evening. So we will be. Hi. Welcome to our week 6 class. So we have one last class next Monday, February 14, and after that we will be wrapping up our financial information class. So again, as a start, I'd like to remind everyone to answer the extra credit activities. Though this is not optional, but this will help you in your achieving a higher grade. Because if you answered all of the, or at least five of the extracurricular or extra credit activities, and possibly get 2 points on each extra credit, so that will be an extra 10 points in your grade. I'd like also to clarify that you need to answer the open class questions. These are the open class submission. If you did not attend this class, you did not join and you did not participate in the actual class. Okay, but if you attend, I'll give you uh, a grade already for that. Okay, so last week we have started discussion on the cash flow statement, and we said that there are essentially three kinds of cash flows. These are your operations, your financing, and your investing. And before we actually delve into the discussion of those items, I showed a discussion on internal and external financing, and I've received some uh, comments from the student if I can explain again this thing. So no worries. I will be explaining it again. Okay. So this is part of your frequently asked question for week number 5. Okay. Okay. So if you note here in your week number 5 discussion, okay, uh, we have two sources of financing. Okay, so the first one is the internal financing sources. So essentially, when we say internal, okay, this means activities that causes the cash to increase because of either financial factoring, meaning the receivables of the company, instead of waiting for the collection period, waiting for the credit term to expire, you already sell this to a financing company, of course, for a discount. Okay? Or you probably avail of an accelerated collection. Okay? Probably giving these companies a discount. Okay? A discount if they pay in advance, or what we call, let's say, credit term discount. Okay? So, for example, if they pay within 10 days, then you give them a 2% discount. If they pay earlier, 5 days, you probably give them a higher than 2% discount. Okay. So you can also sell some of your obsolete fixed asset, or those assets that uh, are not yet that old, but because of fast or abrupt changes in technology, you need to replace them with new machines. Okay, so for example, new equipment, so that your production efficiency will be at par with your competitor. So you have to sell this. Of course, if you sell this, the proceeds will become internal. Uh, it will add up to your internal financing sources. Okay, so you can also ask for increase in capital stock. So what does that mean? You ask for additional investment from the owner. So these are all activities that are confined within the company. That's why it's called internal financing sources. So it's the company that initiates this kind of arrangement. Now look at external financing. Of course, these are also initiated by company, but there are another party that is needed. Look at the example. Uh, when you avail of a loan from a bank, for example, financial institution, you avail of a loan, okay? So that extra money, you can use that for your working capital. So that is an external source of funds, okay? So another one is you float or you issue uh, evidence of indebtedness like bonds, okay? Like bonds, or you sell your promissory notes, okay? So these are additional financing, external financing in that case, that will be helping the working capital of the company. So now there is a problem here, okay? This is about slow debt, SABDCV, okay? Now, what is the requirement here? Okay, when provided with a comparative balance sheet, what are the two examples applied in 2019 for sources of internal financing and sources of external financing? When we say comparative balance sheet, meaning these are two different periods. So in this case, when you see the balance sheet, there's a 2018, that's the first year, and then the second year is 2019. So because you have 2 years already, you can compare what happened. So what is the possible effect? The balance either increase, okay, or decrease, or remain the same. Of course, if it's remained the same, then nothing happened. There is no internal or external financing that happened. Okay, so let's go again one by one here. Let's notice, or in particular, let's take a focus on those items which we know increase or decrease due to changes or due to availment of internal or external financing. Look at the banks. When we say banks, this means cash in banks. Okay? So, Ms. Flores, what do you think? What happened to the balance of the banks when you compared it from 2019 to 20 vis-a-vis or against 2018? Did it increase or decrease, and by how much?
Increase, sir.
Increase. Okay, so how much is the increase? You simply deduct, right? Okay, so in this case, 1,260 minus 20, there's an increase of 1,240. Okay, we don't know yet whether that 1,240 comes from internal or external sources. Okay, so let's look at one by one what happened to the asset account of the company. Okay, so let's take a look accounts receivable. So accounts receivable, what happened, Miss Flores? Did it increase? Did it decrease or just remain the same?
Remain.
Look at again accounts receivable from
Sorry.
240. Okay, what happened? It's now zero, right? So what
Yes,
happened?
po. Decrease.
It decreased, meaning they have collected, right? They have collected, or they have either sold it to a financing company. This is the factoring that I was talking about. You remember, factoring, what is that? Internal or external financing? Factoring, you sell your receivables. What is that? What do you think, Ms. Flores?
Internal.
Internal, correct. Okay, so we will note in your paper, uh, collect factoring of receivables, 240. Okay, so that partially explain the reason for the increase in cash in banks. Okay, 240. But that doesn't explain everything. There's still a balance, right? Okay, so let's go on. Now, look at raw materials. Did raw materials increase or decrease? From 80 to 240.
Increase, sir.
Increase. Okay? So if it increase, it's not possible that they availed of internal financing, right? Okay, because what could probably happen if this is an internal financing, they will sell this all together so that the materials level, the raw materials level will decrease. But the reverse happened. So this is not an internal um, source of financing. Okay, so if it's not internal, then we note you can put here, okay, external financing. Okay, external financing from 80 to 240. Now, Miss Flores, uh, who do you think probably gave this financing? If
Sorry,
it's
sir. Please repeat your
Yeah,
question.
okay. So for example, in this case, from 240, it become 180. So there's an increase of 160, right? Okay. So who do you think provided for this financing? Who supplies the raw materials to the company?
From external, sir. From
External, correct. Very good. So in particular, these are your vendors, your suppliers, right? Your suppliers or your vendors of raw materials. So this one is an external financing provided by vendors. So this is another item. So we'll just keep it in mind. Now, what happened to the work in progress inventory? Nothing. It remained the same. Okay, that goes also with finished goods inventory from 160 to also 160 in 2019. So only accounts receivable, okay, and raw materials inventory change for current assets. Now let's look at the machineries or the property, plant, and equipment. Look at the machinery. What happened to the balance, Ms. Flores, of machinery? Did it increase, decrease, or just remain the same?
Decrease.
Decrease. Okay. It decreased by 1,000, right? Okay. You remember one of the internal financing? You sell your obsolete equipment. So that essentially uh, was the explanation for this um, decrease, no? From 2,100 to 1,100, they sold 1,000 worth of machineries and equipment. So remember we're explaining this figure, 1,000, 1,260, okay? So you have 240 for the factoring of receivables, and then you have another 1,000 for the sale of machineries and equipment, plus the beginning balance of cash in bank. That will explain now your 1,260 ending balance for your uh, cash in bank. So we've explained this fully. Okay, let's move on. Land. Okay, look at what happened to land. From 800 to 1,700. Well, what do you think happened here, Miss Flores? Did they sold or
Increase.
acquire land?
They acquire.
Acquire, very good. So they acquired land. Okay. So we cannot say that the land was internally financed because we've already explained the change in the cash in bank. So if it is not internally financed, then the other option is external financing. So let's look at external financing. This is probably your liabilities. No? Okay. Now, let's take a look first at suppliers. So what happened to the suppliers, Ms. Flores? What happened to the amount? From 140,
Increase.
it increased by 160, right?
Yes,
Okay.
sir.
You remember what I told you when we were analyzing raw materials inventory? There was an increase of 160. Okay. So what happened here? The suppliers agreed to extend credit terms, right? So that extension of credit terms is an external financing because if you don't need to pay immediately, what happens? The money is with you and you can use that money for whatever purpose that you intend to do on a short-term basis, right? Okay, so we can now explain that this increase of 160 from 80 to 240 is related to the suppliers providing additional extension in the payment of the raw materials. So that's why from 140 plus 160, you now have your ending balance of 300. So we have explained already this one. Okay? So this is an external financing provided by the increase in the supplier's credit. Okay? So from 140 to 300. Okay, so this is just short term. Okay, so 40. Now let's take a look at the long-term bank loan. Look at long-term bank loan. From 1,830, it increased to 2,730. So how much is that? Ms. Flores, how much is that?
900.
900. Bingo. You have here your land, right? So this acquisition of land was actually funded by the long-term bank loan of 900. Okay? Okay, so you've explained already this increase in the bank loan. Okay? Now, look at this. Okay, patents, building first, no? Building. The building declined from 350 to 300. But this decline most probably is caused by depreciation, right? Depreciation, because the value of the building, as you go and use the building over time, it decrease. And that goes also with patents, no? So you have patents declining by 10. Instead calling it depreciation, you call this amortization, because this is an intangible asset. So the decline in the cost of the intangible asset is called amortization, while a decline in the cost of the fixed asset or tangible asset is called depreciation. Okay? Okay, there are no issuances of capital, which is again another example of uh, uh, external financing, no? Because these shareholders will be the one providing for the additional capital. Okay, the retained profits is also the same. Okay, so we've explained it, right? Okay, so, but take a look at this. Now, this is just a calculation of the internal financing percentage, no? So it's simply the total of the stockholders' equity over the total liabilities for the latest period, in this case 2018. So let's look at total liabilities. So total liability, okay, is 3,260 for 2018. So you note that 3,260, and then shareholders equity is 1,830. Okay, so what is the ratio of that, right? Okay, so shareholders equity over total liability is 980.97%. Okay, so meaning what does that mean? Okay, it says here, the shareholders offer protection to creditors of 80.97%. It's not fully covered. Okay, so meaning if the company closes at that point in time, of course, the creditors have priority. Okay, but they will not collect the entire 2,260. They will only collect 80.97% or equivalent to 1,830. Okay. Now, what does that mean? Okay. As a creditor, are you comfortable if you are partially covered? What do you think, Ms. Flores?
No,
Do you
sir.
want to be partially covered or fully covered?
Fully covered.
Of course, as much as possible, you like to be fully covered, meaning you can recover everything. Okay? So when choosing which company you will lend, you can probably look at your coverage. Okay? So in this case, your coverage is only 80.97%. So if you invert the equation, meaning the total liabilities over stockholders equity, total liabilities over stockholders equity, that means 123.49%. What does that mean? The coverage of the external financing is 123.49% provided by external creditors. What does that mean? For every 1 peso provided by shareholders, the the creditors provides 1 peso and 23 centavos. Okay? So that's the meaning of that. Meaning there's a greater portion that is provided by creditors. Okay? So, of course, as a creditor, you'd like this amount to be at least 1:1, if possible. Okay? Or the shareholders is the one who provides most of the resources for the company. But in this case, it's not. Okay? It's not. Okay, so the numbers, you can simply compute the numbers, but what is important is you understand what the numbers means. Okay? So 80.97 means as a liability, as a creditor, you're only covered by that percentage. For every peso that you lend and the company went bust, it become bankrupt, you will only recover 0.80 or 81 centavos if you round it off for every peso that you learn that you lend. Okay. Now, what does this mean? Okay. For every peso that was provided by the shareholder, 1.23 pesos is provided by the creditors. Okay. So that's how you interpret all of this. Now, any questions so far? Uh,
Yes, sir.
Flores? Okay, sure. Go ahead.
So based on that example, it's better this with this coverage with 123.49%.
Well, uh, you have to compare it with another company. Okay?
Yes. For
Yes.
example, you have another company to compare. If there's a higher with this one, it's better
Okay.
to choose the higher. The
Okay.
highest.
It depends, no? If you are the creditor and you are looking at this number, no, the ratio of the uh, total liability, sorry, total 1,830 is the liability, right? Let me just double check. 1,830. Okay, I think 1,830 is the total shareholders equity. Okay, let's go back. Okay, so in this case, the total shareholder. Okay, so if you're if you are a creditor, you want this number higher, right? Because you're not fully covered. So for example, if the other company has a number of 85% coverage, that's better. Because for every peso that you lend, assuming everything, uh, the company is liquidated or the company went bankrupt, you will recover 85 cents. While here, you will recover only 81 cents. Okay. So the higher this percentage coverage is better for you as a lender. Are we clear, Ms.
Yes,
Flores?
sir. Yeah,
Okay,
yes, sir.
okay, good. So let me share screen again, the cash flow statement. Okay, let me just highlight some things here. By the way, the sorry, this presentation was already provided to you. Okay, so you can have it. You can take a look at it in my announcement. No? So I shared this already. Okay, let me just share screen again. My screen. Okay, so let's consider some points here about the stockholders. Sorry, the cash flow statements. Okay, so look at this. We said it generates a measure of performance based on the day-to-day cash flow. Okay, instead of accrual accounting's net income performance measure. It means your ordinary course of business. If you are selling your merchandise, that selling of merchandise should provide enough cash flows for operations, no? For your working capital. Imagine if you are a businessman and you don't have enough working capital. What do you think would happen, Miss Flores, if you don't have enough capital? Would you be able to settle your your currently maturing obligations if you do not have enough working capital?
No, sir.
Yes, okay. So you will be constantly bugged by this problem. Oh, where will I source my next payment for my Meralco? Where will I source the next payment for my um, uh, suppliers, right? Okay. Where will I get the payment for the salaries if you don't have enough working capital? So at least you should have uh, a working capital that will allow you, okay, to pay your currently maturing obligations. Of course, as you learn, you will learn in your future business courses, there is what you call an aggressive working capital structure. And there is a conservative working capital structure. Okay? Later, we will watch a video about this. Okay. So again, operations, cash flow from operations, day-to-day cash receipts and payment. Of course, your cash receipts, these are normally your sales, whether it's your cash sales or your collection from receivables. Okay. And of course, your payment, as I mentioned, this can be payment for your suppliers, payment for your utilities, payment for rentals. Okay, your day-to-day, your current maturing obligations. Now, when you say investing, okay, remember in the problem that we discussed, okay, you have your current assets and you have your non-current assets. When you say investing, you are now focusing on your non-current assets. Again, when you say non-current assets, the benefits or the potential benefits that you expect to derive is longer than 1 year. So for example, the building, the equipment, okay, your delivery vehicle, you expect to receive a benefit from those assets over a longer period of time. Okay, and then including investments in other company. Of course, if you have lots of cash already and you want to have business acquisition, like what's happening with the Philippine businesses right now. No? You probably heard about certain acquisitions. For example, in the case of Union Bank of the Philippines, I don't know if you've heard about this, they have acquired the consumer loans, the credit card business of Citibank Philippines. So if you have a Citibank credit card, soon that Citibank credit card will now become Union Bank. Okay, Union Bank credit card. Because it was already bought by uh, the owners of the Union Bank. And there are other acquisitions, um, not only in Philippine setting, but also international companies. Okay, those companies in the United States, no? They're acquiring. So, for example, before there were acquisitions by. You remember Instagram before was different from Facebook. Okay, but now they're the same because Facebook acquired Instagram. When you acquire a company, you invest in that company. And what do you invest? That is cash, right? So that is an outflow from your company. So when Union Bank or eventually when Union Bank pays uh, Citibank, Citibank New York, they will have to cough up cash for that. So that's another explanation for the use of cash. Okay. Okay. So next. Okay. So if you don't have enough money, what can you do? And you want to acquire? Well, you can borrow, right? Okay. You remember your sources of funds? You either source your funds from creditors. In this case, you borrow. Okay. For example, you issue a bonds. Okay. So that's financing activities. Or instead of going to the creditors, you now go to your owners, your shareholders, and then they issue shares. Okay? Shares. Any cash transactions and retained earnings are also included here, especially dividends and share issue costs. Now, you remember, um, when you say dividends, what do you mean again by dividends? Do you remember, Janeline? What is dividends?
The profit, uh, the retained
Yes?
earnings.
Okay, it comes from the retained earning. But this is actually the distribution, okay? Distribution of the earnings to the shareholders. Of course, you invest in the company hoping that you will receive something. That's dividends. And normally,
Shares shares po from the profit of the company.
yes, okay. Uh, it's actually well, the most common term is it's distribution, okay, of profits, na dividends. Okay. So and you normally distribute it through cash, via cash. Okay. So when you pay out, what happens? You need cash to pay out. Okay, so that's financing activities. And of course, when you issue shares, there are attendant costs, there are legal fees, there are SEC fees, there are taxes, there are advisory costs, right? All of these are outflow of the company. Okay, so these are the three kinds: operating. When you say operating, current liabilities, current assets. Okay, when you see investing, you look at your long-term assets or your non-current assets. When you see your financing activities, okay, so you look at your long-term liabilities. Okay, long-term liabilities and your capital. Okay, so it's easy to understand. Operating day-to-day, current assets, current liability. Investing, these are your long-term assets or non-current assets. Financing, these are your non-current liability and your capital. Okay? Okay, so when you sum all of this, okay, so plus this is now your change in cash and equivalents for the period. When you say equivalent, this is not cash, but it's like cash because it's very liquid. You can easily convert it to cash, right? So for example, you have treasury bonds with maturity of 30 days. It's very it's near maturity and you can easily sell this. So that is your cash and cash equivalents. Okay. Okay, and then you add your beginning of the period. So you now have your ending cash for the period. So all of this plus the beginning cash, okay, then you have your ending cash for the period. Now, before we go on with the discussion, let me play a video. Let me just share screen. Stop sharing. Okay. So let me share this video. You can also find this video in your. Okay, give me a second, please. Let me just pull out that file. Okay. So this video shows about working capital, right? You remember I said when you say working capital, these are your cash flow from operation. These are your current assets and current liability. Now, for those who did not attend this, okay, this is one of the questions that is needed to be answered. Okay, so what do you mean by uh, what is working capital? And how do you use working capital? So this is the question. How do you use working capital to evaluate the company's financial health? So let's watch this video and let's see the answer.
Working capital is a measure of a company's financial strength. Pete is thinking about investing in the automotive industry, and he has his eye on two companies, Arthur's Engines and Joe's Motors. Pete calculates the working capital for each company. Arthur's Engines has $200,000 in current liabilities, that the company must pay this year, and $320,000 in current assets, that can be converted into cash in less than a year. Pete subtracts current liabilities from current assets for both companies and discovers that Arthur's has $120,000 in working capital. This means the company can easily pay down its short-term liabilities or debts using its current assets. This is a sign of a profitable and efficient business. Joe's Motors, on the other hand, has $400,000 in current liabilities and only $360,000 in current assets, meaning the company has a working capital of negative $40,000. Negative working capital suggests that Joe's may have trouble paying its short-term debts. Joe's might be forced to sell an asset or raise more capital through long-term debt like a bond. Or in the worst case, the company could go bankrupt because it can't pay what it owes. Because of Joe's Motors' negative working capital, Pete chooses Arthur's Engines as an investment. Working capital helps investors judge a company's financial health and future prospects. But no single measure tells the whole story. Working capital is one of many metrics investors use to evaluate a stock.
Okay. Okay, so let me. Were you able to see that video, Janeline? Hello, Janeline. Ah,
Hindi
okay,
ko po
sorry.
nakita kanina, sir.
Sorry. I forgot to share screen.
Okay lang po.
Okay, let me share it again.
I-review ko na lang po.
Okay, let me share it again. No worries. Are you seeing it now?
Working capital is a measure of a company's financial strength. Pete is thinking about investing in the automotive industry, and he has his eye on two companies, Arthur's Engines and Joe's Motors. Pete calculates the working capital for each company. Arthur's Engines has $200,000 in current liabilities that the company must pay this year, and $320,000 in current assets that can be converted into cash in less than a year. Pete subtracts current liabilities from current assets for both companies and discovers that Arthur's has $120,000 in working capital. This means the company can easily pay down its short-term liabilities or debts using its current assets. This is a sign of a profitable and efficient business. Joe's Motors, on the other hand, has $400,000 in current liabilities and only $360,000 in current assets, meaning the company has a working capital of negative $40,000. Negative working capital suggests that Joe's may have trouble paying its short-term debts. Joe's might be forced to sell an asset or raise more capital through long-term debt like a bond. Or in the worst case, the company could go bankrupt because it can't pay what it owes. Because of Joe's Motors' negative working capital, Pete chooses Arthur's Engines as an investment. Working capital helps investors judge a company's financial health and future prospects. But no single measure tells the whole story. Working capital is one of many metrics investors use to evaluate a stock.
Okay. So as we seen in the video, okay, so there's an investor who wanted to select two companies, right? Okay, so you have Arthur's business and then Joe's business. Now he focused on working capital. Okay, so we said working capital, okay, current assets minus current liabilities. So in the first company, there was an excess of working capital. Meaning, if you are the supplier, you're confident that you will be paid. If you are the um, employee, you are confident that you will get your salary. Okay, because there's an excess or surplus working capital. What about in the other business, Joe? Joe has a negative working capital, a negative 40,000. So what does that mean? Well, it doesn't mean doomsday at once, but there might be some difficulties in paying the obligation, especially if the obligation, the maturity is very near each other or on the same day. So there will be a problem on paying. So what will happen? The company will now be forced to issue additional bonds or long-term indebtedness. Of course, if that happens, that is an extra expense on the part of the company or raise capital, which the shareholders will be asking again for more dividends in the future. So by that matrix, focusing on that matrix, okay, the investor selected Joe because he has more or he has a positive working capital. Okay. Now, let's take a look at how do we prepare. Of course, the one who will really prepare the cash flow statement is really the accountant. No? But let's just have uh, a viewpoint on this on the preparation. Okay, so, sorry. Let me just share screen again. Okay. So let's take a look at how do we prepare the cash flow statement. There are actually two methods, the direct method and indirect method. Direct and indirect. So what is the main difference of that? Okay. In the direct method, you can clearly see how much was collected from the customer. Okay, so this is an example. Okay, okay, look at this. If you are using the direct method, you start with operating cash receipts. Okay, so these operating cash receipts, most of these are your collections, your cash sales, right? And then you deduct your operating cash payments. Let's take a look at that. Okay, so you look at this as an example of Oakwood Military Supply. So you start with the beginning cash. Okay, so if it is an annual financial statements, this is your January 1st cash balance. And then what are the cash receipts for the year? Well, you have there your direct amount for cash sales, 73,320, and then direct amount again for the collection from the customers or collection from accounts receivable, 17,894,530. And then you have your proceeds, meaning you sold land, you issue new debts, you issue new shares. So these are all the proceeds. For the sale of land, 1.2 million. For new bond debt, you receive 5.3 million. And from the issuance of new shares, 840,000. So what can you see in the direct method? You know how much comes from sales of land, how much was cash sales, how much is collections. So that is the advantage of the direct method. Okay. Look at the cash payments. Similar to the cash receipts, you now see how much was the exact cash paid for expenses, 49,210. How much was the exact cash paid to suppliers and employees for their salary, 14,992,860. How much was the exact cash that was paid for income tax? Okay, cost of dividends, okay, cost of new shares, repayment of non-current debt. So if you want to know, again, this is probably one of the question. If you want to know the exact amount that was paid, or you choose the direct method, because you can clearly see where did the cash comes from, cash receipts, and where was the cash actually used, cash payments or disbursement. And then you just deduct this and you have your ending cash balance. So that is the direct method. Of course, all of these are acceptable methods in preparing. Now, let's take a look again at your indirect method. Now, the indirect method is actually a reconciliation. Okay? You remember the financial statements are prepared using the accrual method. You don't wait for the cash to be collected, or you don't wait for the expenses to be paid in cash. The moment you incur, you already record it. So there is a reconciliation from the accrual method. You now reconcile so that it will become cash method. So you start from the accrual net income, and then you remove the effects on income of non-cash expenses. Okay, you recall I said there's the depreciation. Okay, depreciation is the reduction in the value of the asset. But there is actually no cash payment for that because you've already paid. For example, if you purchase an equipment, you pay the supplier on day one. But you allocate the cost of that over the years. But there is no cash out. Okay? So what is the effect of that? Your net income, okay, is understated by that amount because you have deducted depreciation. So if you deducted depreciation, and you want to make it on a cash basis, you just add it back. That's the simple explanation. Now, you also remove the effects on income of uncollected revenues, okay, unpaid expenses, and other items in working capital. So, for example, if there is an increase in receivables, okay, what is the entry if you record your receivables? Isn't it that you debit receivables and then you credit revenue, okay? But you don't receive the cash. So what happens? You don't you need to eliminate or remove the effect, but not the entire amount, only the profit portion. Okay, only your profit portion. Later I will show this one. No? That is also for your unpaid expenses and other items. Okay, let's see an example of this. Okay, is there an example? Okay. Uh, I don't think I have an example here. Okay, anyway, uh, in the next meeting, I will show an example. Okay, so you will see that there is a reconciliation of the balance sheet, of the accrual to cash basis. Okay, so do you have any questions so far, Janeline, about the direct method?
Uh, Sir, the direct method is like the short way of cash flow.
Well, it's not actually a short way, but
Analyze.
you identify the exact amount because I think I have a sample here. Uh-huh. There's no sample here. Okay. Okay, let me share screen. Let's search in the internet an example of an actual financial statement. Okay, so let's go to let's say PCCI. Okay, Philippine. Okay, so this is an example of a company, pccigroup.com.ph. They have an actual financial statements on this. Are you seeing my screen right now?
Yes, sir.
Okay, so let's look at their financial statement. Okay. Company disclosures. Okay, audited financial statements for 2020. Okay, here. Sorry, I think I have to go to the first. Okay, this one. Okay, so this is an actual audited financial statement of Philippine Commercial Capital. Okay, let's take a look at their uh, cash flow statement. Okay, here, Janeline, are you seeing this now? So
Yes.
look, this is an indirect method of preparing cash flow statement. So from the accrual net income, you make adjustment. Okay, so for example, there is an adjustment for depreciation because this is non-cash. So depreciation was deducted in the accrual. So to make it cash, if you deduct, you reverse, you add, right? Yeah, so there's an addition. Now, look at these retirement benefits, okay? This retirement benefits is the expense for the retirement benefits. But the individuals or the employees have not yet retired. But this was already deducted from this net income before income tax of 28,000. How do we know? Because retirement benefit is a deductible expense of a company. So if you deduct to make it cash, you add it back. You add it back. So that's an example of this. And then look at this one. You look at the receivables. Huh? Receivables, there is a deduction of 22 million. Let's take a look at that. Look at the receivables, the balance sheet. Okay, you look at the receivables. In 2019, the receivables is almost 14 million. In 2020, it's now 36 million, meaning they use more cash to fund that receivables, right? So instead of factoring, instead of making that as an internal source of funding, the reverse happened. They needed more funds for that. So if you need more funds for that, that is a use of cash. Okay, so look at that. 22 million is an actual use of cash. Okay. Here, it's a negative. It's a use of cash. Okay. Now, the rule here, okay, if your asset decrease, you had you have to make the effect here plus because you're actually um, let me repeat that. If your asset increase, for example, in that case increase, you're actually using cash. Okay, so when you use cash, it's a reduction, right? So you see here, it's a reduction. If, for example, your receivables actually decrease, meaning you collected more, so what happens? You now have a factoring or an additional cash. Okay, so the rule here, if you just want to do the you compare the current assets and current liability, and if there's an increase in current assets, you deduct here. If there's a decrease in current assets, you add here. Okay, so it's a reverse relationship. Now for liability, current liability, that's another story. Okay, it's parallel. So meaning if liability increase, you have to increase cash here. Okay, because for example, you remember the supplier? Okay, the supplier extended more credit. Okay, yung in the previous problem, it extended more credit. So what happens? Instead of the company paying immediately, they have the cash. Okay? So it's an addition to your cash flow. But don't worry, I don't think you will be asked to prepare this one. No? But just remember, if you use cash, okay, it's a deduction here. Okay? If you conserve cash, it's an addition here. Okay? So that's the so these are actual financial statement, and you can look at many financial statement in the company's website. Okay, so I think that will be all for tonight. Um, please answer I posted something in the forum 3 second leg. Okay, Forum 3 second leg. Please try to answer that as well as your exams for this week. Okay, so if there's nothing else, Jonalyn, thank you so much. I will see you
Thank you,
again
sir.
on week 7, our final class. Okay, thank you.
Thank you po.